I'd like to go on now to a couple of charts that I think will help show the flow of funds for ERGA. This first chart is going to show that, and this is part of what is defined in the development agreement as the required flow of funds. All gross revenues that come into ERGA are put into the Treasury. Then as priority, we first pay operating expenses. Second priority is to fund a short-term capital reserve fund, which is 3% of gross revenues, and a long-term capital reserve, which is 1% of gross revenues. Then the next priority is to make the required payments on the golf course bonds. Those bonds were issued originally in around 1996 or 97, and they paid for the construction of the course, and ERGA is responsible for repaying those bonds. Then we come to a line that's defined in the agreement as excess golf course net revenues. The next step is that a portion of the Community Facilities District bonds that were issued to build the infrastructure for the Encinitas Ranch, it was determined that a portion of those construction costs directly benefited the golf course, and that is about 16% of the overall costs, and that related to the building of Leucadia Boulevard through that area and other infrastructure. The development agreement requires that ERGA pay its fair share of those bonds if there are net revenues available to pay those bonds. And then we get to the next step, which is surplus golf course net revenues, and that is more the focus of tonight's presentation. Surplus golf course net revenues in this period from around 2008 to 2013, if there are surplus golf course net revenues, they're shared 50% to the developer, but only to repay the city loan. And that I'm referring to the city loan as some people have called it the sales tax advance. I'm going to refer to it in this presentation as the city loan. So 50% to the developer, but only to repay the city loan, and the other 50% goes to the city through 2013. After that, 100% of surplus golf course net revenues go to the city until such time as all debt is paid off on the golf course, and that includes the golf course bonds and the fair share of the Community Facilities District bonds. Thereafter, for 25 years, the surplus golf course net revenues are shared 50% to the developer and 50% to city.